Hello and welcome to Chapter 13. Chapter 13 will introduce us to the concept of capital, as well as take a look at some of the financial markets that businesses operate within. In particular, we're going to start by taking a look at the different forms of business ownership, because this can be an important consideration when looking at the capital options that are available to any business. We'll also then take a look at the evolutionary process that firms go through over the course of the business life cycle. And we'll look at some of the different sources of capital or sources of funds that are available to managers as they look to expand and look at some of the reasons that firms will need capital. And we'll take a look at the different sources of funds that might be available for not-for-profit organizations. So one of the key factors to consider when setting up any business is the type of legal structure that will be used. In particular, when trying to determine what business ownership legal structure to use, we're going to take a look at 5 main factors that will influence that decision. The first being the ease of business setup and operation. Some forms of business organization are easier to set up than others. The second is the degree of control that an owner desires. The third is the magnitude of risk that individuals are willing to take on. The fourth is the capacity of individuals to provide the financial needs that are required, so the ability to access capital. And lastly, the anticipated skills that are required for success for each of the forms of business organization. We'll also take a look at the how that will evolve through the business's life cycle. As the needs of an organization change, we're going to see that we may evolve from one form of legal structure to another. Particularly as a business expands, it may look at moving from a sole proprietorship, perhaps then to a partnership, and finally to a private or a public corporation. So as the needs or as the risk changes in the organization, so will the business ownership options may need to change as well. You'll recall from other business courses or IB1 that there's 3 basic forms of legal structures that we're going to take a look at. The first is a sole proprietorship. The second is a partnership, and we'll be taking a look at the different forms of partnership. And the third is corporations, and again, we'll take a look at the different forms of corporations that might be available. So those are the 3 basic legal structures, and we're going to take a look at those in conjunction with the 5 main business factors that are cited above. So in short, of those 3 main business ownership options, the sole proprietorship, the partnership, and the corporation. So those are the 3 primary forms. But we're also going to discuss the 2 forms of partnership. First being a general partnership, and the second being a limited partnership. Similarly, when we talk about corporations, we're going to take a look at the 2 types of corporations. One being a public corporation, where the shares are listed for trade on one of the stock markets, or a privately held corporation where the shares are not traded to the public for on one of the recognized exchanges. So keep those forms of business organization in mind as we go through the rest of this chapter. So let's take a look at the concept of a sole proprietorship. And you'll recall that a sole proprietorship is really a business that's owned by one person. There's no separation between the business and the individual running it. There's no separate legal distinction between the business and the owner of that business. A sole proprietorship really is the easiest way to start operating a business. And in essence, the individual and the business are one and the same from a legal perspective. Very easy to start a sole proprietorship. Often all that's required is registering the business and picking a name for the business and registering that with the provincial government. One of the key things to keep in mind when looking at a sole proprietorship is that the debts of the business are deemed to be debts of the owner. So if you are operating a business as a sole proprietorship and for whatever reason the business gets sued for a large sum of money, the owner of that business is also legally responsible for the debts of that business. So in essence, whoever was suing you could go after your personal assets and personal home, cars, cash, that sort of thing as well. So the debts of the business are deemed to be the debts of the owner, and that's one of the risks of operating a business as a sole proprietorship. In a sole proprietorship, as we said, there's one owner, and so a key advantage is that the owner has 100% control of the business and all the business decisions that are made for that business. But a key risk is that they are 100% responsible for the liabilities incurred by that business. One of the disadvantages of the sole proprietorship is that the skill set of the business is often limited to the owner's skills. So we may have some skill gaps in a sole proprietorship. There are some good businesses that continue to run as sole proprietorships by bringing in some key employees into the business that perhaps can complement the skills of the owner. However, sometimes it's difficult to keep those employees. And another disadvantage of the sole proprietorship is that the resources that are available to start or expand a sole proprietorship are often limited to the resources that the owner, the individual owning the business, can invest into the business. So it can be very difficult for some sole proprietorships to expand or accumulate or have an access to other forms of capital in a sole proprietorship. So in summary, key advantage of a sole proprietorship is how easy it is set up. There's not a lot of legal costs to set up the business. Very easy to do. Hang out your shingles, so you're going to operate a business and register for a business name, and you're off and running. The second key advantage is the owner has 100% ownership and full decision-making control. And the owner is, because he's got 100% ownership, he gets 100% of the profits of the business. A disadvantage is the unlimited personal liability for the risks associated with the business. So that means that they are liable for all debts of the business personally. Limited access to financial resources is a risk or disadvantage of a sole proprietorship. And the skill set is often fairly limited to the skills of the sole proprietor, and so difficult to retain and attract talent and skills in a business operating as a sole proprietorship. Sole proprietors are also sometimes will have some tax advantages because they are not a separate legal entity. All the profits of the business are really taxed in the hands of the sole proprietor. There's no separate tax return that's done really for the business. You are taxed on the income of the business just as you would as an individual. So there's no special complex taxation, and sometimes can be at lower tax rates. Another key form of business ownership is called a partnership. And a partnership really is a business organization that's formed by two or more individuals. So unlike a sole proprietorship that has one owner, a partnership has two or more owners. And a partnership really comes about by two entrepreneurs decided to enter business for themselves. And while not a legal requirement, a partnership agreement is an excellent document to have to set forth the expectations of each of the partners in the partnership. A written partnership agreement outlines the expectations of the partners, details what the business is going to be, how the partnership is going to work, who's responsible for what in the partnership, how will profits be divided within the partnership, what are the contributions, the cash injections required by each of the partners. And it also will outline some of the things that the partnership will do in the event of a dispute of partners. Will it go to mediation, and what does that process look like? A good partnership agreement will also outline what the steps are when the partner wants to leave, or what happens when a partner dies. How will the partnership be evaluated? How will the partnership assets be split up in the event of dissolution of the partnership, etc. So very, very good document to have, and should be looked at for any entrepreneurs looking at entering a business with another partner. In a partnership, each of the partners have joint and several liability. So that means that each of the partners are responsible for all the debts of the partnership. For instance, if there is a lawsuit for $1 million against the partnership, against the business, each of the partners are fully liable for the full amount of the debt of the partnership. So they share it. So they share the full liability for all the debts of the partnership. Keep in mind that partnerships are not separate legal entities from their owners, and in fact, very similar to a sole proprietorship. They are the partners and the business are one and the same. A good thing to have in the partnership agreement or as a separate agreement is a buy-sell agreement, and really what that is a written agreement amongst the partners that details what will happen if one partner decides to sell or retire, and how that interest will be paid out, or how it will be sold to perhaps a new partner coming into the partnership. As we said earlier, there are two main forms of partnership. One is a general partnership, and in a general partnership, all partners are considered general partners, and they have full liability for all the debts of the business. There is a special type of partnership called a limited partnership, whereby you have one general partner who is responsible for all the debts of the partnership, i.e. they have unlimited liability. And you can have one or more limited partners. Those limited partners have the advantage that their liability is limited to the capital that they've contributed to the partnership. So they are not fully liable for all the debts of the partnership. Their liability is limited to the amount that they have injected into the partnership. However, in a limited partnership, the limited partners cannot participate in the management of the business. So they're kind of like silent investors, if you want to think of it in that terms. They are entitled to, some sort of distribution of the profits of the business. They are limited to the amount of the liability of the partnership, but they cannot participate in the management of the business. As soon as they do, they are determined to be general partners, and then will have full liability for all the debts of the partnership. Any limited partnership must have at least one general partner, and they are responsible for running the business and operating and managing the business, and have full liability for all the debts of the business, and can have one or more limited liability partners who do not participate in the management of the business. So in terms of ease of setup, again, partnerships are very easy to set up. Not a lot of legal requirements. However, it is strongly recommended that a partnership agreement and buy-sell agreements are done by a lawyer before setting up a partnership. In a partnership, the ownership and decision-making is divided amongst the partners in accordance with the partnership agreement. It doesn't have to be equal. It doesn't have to be, every partner doesn't have to have the same responsibilities or be entitled to the same percentage distribution of the profits of the business, and because there's more than one person making decisions often in the partnership, there's the possibility of conflict and in the partnership, and disagreements in the partnership. So very important to have a good partnership agreement up front. In a general partnership, just like a sole proprietorship, each of the partners are fully liable for all the debts of the business. In a partnership, because there's more than one owner, usually the business will have greater access to capital, because now there's not just one person that is trying to raise capital to inject into the business, but there can be a multitude of partners who may have access to funds to inject into the business, which will help it grow and expand. And in terms of skills required, because there's more than one individual running the business in a general partnership, you can bring in different skill sets, and some good partnerships bring in partners with different skill sets. Perhaps one partner has a strong skill set in accounting and finance, another has a strong skill set in terms of HR management or marketing or operations management and that sort of thing. So a little bit easier to bring in and increase the skills required in the partnership or to operate the business successfully. Again, keep in mind that generally in a general partnership, all partners have unlimited liability. Many sole proprietorships will evolve into a partnership as they grow and expand, or as they find that they have a need for additional capital and different skills in the organization. The third basic form of business ownership is a corporation. And a corporation is somewhat unique in that it is, from a legal perspective, separate and distinct from its owner. So a corporation really is a separate individual or a separate person in the eyes of the law. And a business can go through the process of incorporation. And what that is the legal process of setting up a corporation. What that means is the business is given life as a separate legal entity by either the provincial or federal government through the incorporation process. It can be an expensive process. It does involve lawyers, so one of the disadvantages of corporations is that there are upfront legal costs and a little bit more complexity in setting up a corporation, unlike that of the sole proprietorship or the partnership. A corporation really is governed by the board of directors. The board of directors of a corporation are either appointed or elected, and they are responsible for the overall management of the business on behalf of the shareholders and stakeholders. The shareholders of a corporation are really the owners of the business, and they may or may not participate in running the business at all. One of the biggest advantages of a corporation is that the corporation is a separate legal entity. So the owners, or the shareholders, as we call them, are not responsible for the liabilities of the business. Hence, many businesses will start as a sole proprietorship. Sometimes as they grow, they will become partnerships. However, as they continue to grow and the risk continues to grow in a business, many businesses will then go through the process of incorporation to protect the shareholders of that corporation from the liabilities of the business. In a corporation, the ownership rights are usually defined by the number of shares that the shareholder will own. In some cases, there may be one shareholder that owns 100% of the shares, and the shares represent the ownership of the corporation. Or for many large corporations, such as Bank of Montreal, there are literally thousands and thousands of shareholders, and their ownership, their individual ownership interest is represented by the number of shares of the stock or that the business has issued. Because corporations can issue shares which represent the ownership, corporations have the unique ability to raise capital through the issuance of shares, whereas partnerships and sole proprietorships cannot do that. So corporations have a much larger access to some available forms of capital by attracting other investors in the corporation. However, there are some tax incentives and deductions that are not available to sole proprietorships. In a corporation, the corporation files a separate tax return, and it is taxed on the earnings of the corporation. One of the disadvantages of a corporation is that they are taxed, or the owners sometimes are taxed twice on the profits. So let me explain that. So because a corporation is a separate legal entity, it files its own tax return, and it is taxed based on the profits that are generated by that corporation. As a shareholder, we might receive dividends, and dividends is a distribution of the profits of a corporation to the owners or to the shareholders. So that's how the shareholders, or one of the ways that the shareholders can make a return on their investment is through the payment of dividends by the corporation. So the corporation declares a dividend of X number of dollars per share, and each of the shareholders will receive a prorated share of that dividend based on the amount of shares that they own. However, those dividends are paid with after-tax dollars. So the corporation's already been taxed on the profits generated and is paying those dividends with the after-tax profit. Then, when the individual investors receive their dividend check in the mail, they then must include the amount of dividends received as income on their personal income tax return and are again taxed on the amount of dividends that they have received. So the corporation is taxed on the profits. The individual shareholders are taxed on the dividends that they receive, which are paid out of the after-tax profits of the corporation. So that's the concept of double taxation for investors in or the shareholders in a corporation. Now, to help alleviate that double taxation impact, most provinces, as well as the federal government, have some form of dividend tax credit to help alleviate the burden of that double taxation under our Tax Act. But something to keep in mind when setting up your business as a corporation. So again, corporations are more cumbersome to set up, more difficult. There's a process to go through, legal fees to set up the business. There's also more regulatory requirements for corporations. There's a separate tax return, and hence more expensive for some of the legal requirements of a corporation. So they are more expensive and more difficult to set up, as well as maintain the corporation. The degree of control also can be diminished in an organization, because now we don't have one owner like in a sole proprietorship, but often we may have thousands of owners, and each owner may have a very small percentage of the control, particularly in a public corporation. So some of you may own shares of, some of the banks or insurance companies and trust companies and that sort of thing, or shares of Microsoft. And your ownership interest probably is fairly small, so you don't have a lot of control over the decisions made by the board of directors of the corporation. The key benefit or key advantage to setting up a corporation is, of course, that you've now created a separate legal entity in the eyes of the law through the articles of the corporation, and hence the shareholders are not legally responsible for the debts of the corporation. So that is one of the primary benefits of a corporation, and is a reason why most businesses in Canada, in terms of the number, are actually incorporated entities. We're seeing a lot more small farms even that incorporating simply to protect the owners of the farm from this concept of unlimited liability that exists for sole proprietorships and partnerships. Because corporations do have the ability to issue shares, they can raise capital sometimes easier than sole proprietorships and partnerships. And the corporation can also borrow money in its own name, separate and apart from the shareholders or the owners. Corporations tend to be larger companies, and they tend to attract employees more easily, and so many corporations are able to attract and retain employees in them, which broadens the skill set in the business. So that can be another advantage of a corporation as well. Keep in mind that there's really two types of corporations. The first is a private corporation. And a private corporation does not have its shares listed for trading on one of the recognized stock exchanges. The shares are held by shareholders, but there's a smaller number of shareholders to be a private corporation. I think the maximum number of shareholders is 50 in Canada. So there are some restrictions on the number of shareholders in a private corporation. Versus a public corporation is corporations whose shares of stock are traded on at least one of the recognized stock exchanges, and really can be purchased by anybody. So if you're interested in being an owner of a public corporation, all you have to do is go to your stockbroker and ask him to purchase some shares of that corporation on your behalf, and those are traded in the secondary markets. Corporations that are just starting out or are looking to go public, which means offering the shares of sale to the general public, go through a process called an IPO, and IPO stands for Initial Public Offering, which is the initial sale of stock by a corporation through the public exchange. So if we've decided we set up a corporation and we want to raise some capital, we can list, through an IPO, we can list for sale shares of our corporation through one of the stock exchanges through an initial public offering. And hopefully there will be some market interest and shareholders will start purchasing our shares. Once those shares are issued, however, so the corporation receives the money for the sale of shares through an IPO, but once those shares are issued, any exchange of shares from shareholder A to shareholder B really don't affect the company at all. Those shares between owners or shareholders of a public corporation can be traded amongst themselves and really has no impact on the cash flow of the corporation at all. So we call that the secondary markets. That's when shareholders will offer for sale their shares, and other shareholders hopefully will purchase their interest in the corporation. Some shares are publicly traded through a network, an electronic market, which is called the over-the-counter market, versus a recognized stock exchange. Keep in mind that any publicly traded corporations have a lot more regulatory items to deal with, have lots more regulations through the Securities Exchange Commission that they need to comply with, and are very heavily regulated. So that increases the costs and sometimes the amount of time to raise capital through an initial public offering. So keep that in mind as your business expands, that there are some additional costs when going public. So as we've previously said, for many individuals, starting a business as a sole proprietorship is often the easiest route to go. But as it continues to expand and as it needs more capital to increase, or perhaps the risk of the business starts to increase because we're becoming larger in size, increasing our customer base, corporations will often look at moving to another form of business organization. And so a sole proprietor might then decide to take on a partnership, take on a partner and become a partnership, or might decide to incorporate the business and sell shares. So business owners really have to be aware of the financial capacity of the business. Keep in mind the concept of liability and the risks that are being incurred in the business and the skill sets necessary for success. And as any of those increase, we will probably move from a sole proprietorship more to a corporate form of organization. So keep in mind the need to raise capital to fund future needs can and often will play a key role in that decision-making process to become a corporation from a sole proprietorship, for example. One of the primary responsibilities of any manager of the business is to assess the organization's need for financial resources and then determine on how those needs are going to be met. So that means that all managers need to review our capital structure and make decisions on how we're going to finance its operations and what will be what is the optimum mix of the different sources of funds that are available to the business. In Mike Spikes, you've probably taken a look at your debt equity ratio, which is a ratio that measures the amount of debt financing versus equity financing in a business. And you will learn more of that as we go into the next chapter on financial analysis and financial statements in chapter 14. But knowledge and understanding of the debt equity ratio in a business is key to determining how to raise capital in a business. And when we talk about capital structure, we're talking about the organization's mixture of debt, internal cash reserves, and external equity-based investments. Because for profit-oriented organizations, there's really three sorts of funds. Those that are derived from operations, and that's the general profitability of the business. The second is funds raised through credit facilities, which is debt financing, and the funds earned through equity financing, which is ownership financing. Finding the optimal source of those three sources of funds is critical for any business owner. Just like when you are managing your bike spikes, if you're looking at expanding, you will have three sources of funds: those profits that you've generated, getting loans from a bank or other creditors, or issuing shares and getting some ownership financing or equity financing. So this slide illustrates, again, some of the different sources of funds. So when we talk about funds from operations, we're really talking about profitability each year. So that's the current year's profits of the business, as well as retained earnings, which is an accumulation of the previous year's profits that are retained in the business and not paid out in the form of dividends. Second type of financing is debt financing, and we'll take a look at the different types of debt financing: short-term financing versus longer-term financing. And the third primary form of capital is equity financing through various forms of ownership participation or ownership financing in the business. And we'll take a look at each of those as well in the following slides. So let's take a look at some of the funds that are derived from operations. So funds derived from operations, it really refers to two internal sources. The first, as we've mentioned, is operating profits. Operating profits is the total revenues of the business less all of the operating expenses. So this determines the amount of profit that's available for the business. And the after-tax profit is the amount that can be paid out to investors or owners in the form of dividends, or reinvested or retained in the business and form part of retained earnings, which will support future growth of the business. The second is retained earnings. So that's the cumulative profits that have been retained in the business to fund its future growth. So those are the two key forms of internal sources of funds in any business, whether you're a sole proprietorship, a partnership, or an incorporated entity. So it's really important to understand that the operation itself represents a viable source of cash and capital for future expansion, as long as it is profitable. And sometimes taking a look at the amount of cash that the business has as reflected on the balance sheet is an easy assessment of the capacity of the business to fund future expansion through internal resources. The second form or source of funds is through debt financing. When we talk about debt financing or credit financing, really these are debts that an organization has taken on to support its business activities. So we are loaning money from another organization or another individuals with the expectation that it'll be paid back over a period of time. So any credit facility is a form of debt financing. And with debt financing, there is the legal obligation to pay both the principal back when it's due, so that's the amount that's borrowed from another party, as well as there's usually a legal obligation to pay back not just the principal, but interest. And interest is an expense that the business must be able to pay back. And so credit or debt financing increases the risk to a business because as we accumulate more and more debt, we have more and more strain placed on our cash flow because we have to pay back that debt at some future point in time, and we also have to pay interest on that debt, which reduces the profitability of our corporation and hence the amount that's left over for owners. So keep in mind that debt financing is higher risk financing, but is generally a cheaper form of financing than equity financing. So debt can be a very attractive form of raising capital in your business, as long as you keep in mind that if too much debt can be a bad thing because it may make it difficult to keep up those payments on the debt. And if we stop making our principal and interest payments, our creditors can perhaps look at forcing us into bankruptcy and liquidating the assets of the company, etc. So be cautious in having too much debt financing. When we talk about debt financing, we're really talking about two main categories, either short-term debt financing or short-term credit facilities and longer-term credit facilities that are paid over a longer period of time. So let's take a look at both different sources of short-term and long-term credit facilities. So again, short-term credit facilities are debt obligations that an organization takes on for a shorter period of time, generally less than a year. So typically that will include trade credit. So that is when perhaps we are buying inventory from our suppliers and they will permit us to pay the invoice for our inventory, in 30 days, 60 days, etc. Sometimes short-term financing will include a line of credit with a bank. So that is with the expectation that it be paid back as we collect on our receivables or sell our inventory to our customers and in turn generate a profit and then pay back the bank. So a line of credit is another form of short-term financing. Accounts payable is money owed to our suppliers and short-term service providers. The largest amount of accounts payable will be for amounts that we have bought on credit from our inventory suppliers. Accounts receivable is money that's owed to our organization by our customers. So we have sold goods and services to our customers on credit so that we will permit them to pay us in 30 days or 60 days or whatever the case may be. Keep in mind the concept of collateral when looking at debt financing, either short-term financing or long-term financing. And collateral means an interest that we grant to the debtor, to the creditor, to act as security for non-repayment of that debt. So if, for instance, if we get a line of credit with a bank, we might grant them collateral over our inventory or accounts receivable. So if we don't pay back the bank, they have a right to go and collect our accounts receivable or liquidate and seize the inventory that we have for sale and try to sell it to recoup their investment or the obligation or the monies that were lent to the corporation. Long-term credit facilities are debt that is paid over a longer period of time, generally over a year. sometimes for extended periods of time, 20 years, 30 years, etc. Some common forms of long-term debt are bonds, mortgages, longer-term promissory notes, lease obligations, etc. And when taking out any form of debt financing, and particularly long-term debt financing, we have to really consider the cost of borrowing. Typically for longer-term credit facilities, the cost of borrowing is higher than short-term debt. So there is a higher cost with long-term debt. The interest rates that we may need to pay out or pay to our creditors is higher than for short-term financing. And keep in mind, any credit facility, we must pay back not just the principal amount that we borrowed, but interest over the term of the contract as well. So long-term debt really can have a significant impact on the cash flow of our business, because some of the cash flow has to go to pay back our creditors. And keep in mind that any of the interest that is that we pay on both long and short-term debt is a business expense, and that reduces the profitability of our business. Keep in mind, though, that the principal payments is not an expense. It has an impact on cash flow, but it is not an expense, so it does not reduce profitability of the business. Only the interest component does. Bonds is a type of long-term financing. It's really the use of funds over a long period of time. Often bonds run for 30 years. So if we as a corporation decide to raise some capital by the issuance of a bond, we will have an extended period of time to pay for those bonds. And bonds come in many shapes, forms, and sizes. Some with lots of different options that are available to the purchaser of our bond. So they're a long-term legal obligation to pay back the face value of the bond on a specific date in the future. And often that bond will not be due for 30 years. So many businesses have to establish some sort of reserve or fund to be able to liquidate that bond when it comes due. So if we are looking at raising some capital through the sale of bonds, we'll typically do that through an investment firm. So again, it is more costly, and there is a bond contract that's called an indenture that outlines the legal responsibility of the bond issuer. And once a bond has been issued or sold to an investor, that investor can resell the bond in the marketplace. And because the bond has a long time to maturity, the market value of the bond may change from time to time based on movement in the interest rates. And I'll explain that in a little bit more on the next slide. So the issuance of bonds is not limited just to corporations. Many municipal organizations, such as the provincial, federal, municipal governments, all issue bonds as well. And buyers of bonds really focus on three main criteria when determining whether a bond is attractive or not. And some key concepts that you need to understand are, first of all, the coupon rate. And the coupon rate is the interest rate that the bond will pay based on the face value of the bond over a period of time. Typically, bonds pay interest semi-annually at the coupon rate. So the coupon rate is the interest rate that is a fixed interest rate that is paid to the holder of the bond. And that interest rate will be impacted by the risk rating of the entity issuing the bond. So if it's a higher risk bond, the coupon rate would be higher, as well as the duration of the bond. So the coupon rates on 30-year bonds generally will be higher than the coupon rate on, for example, 10-year bonds, because the risk is higher. Second key concept when talking about bonds is the face, or sometimes called the par value of the bond. So it's the amount that the issuing organization agrees to pay the bondholder on maturity date, and the maturity date is that future date when the principal payment is due. So that might be in 10 years, it might be in 15 years, might be in 30 years. So that's when the full amount of the bond is due in full. So as we said on the previous slide, the issuer of the bond will go through a process of selling the bond for the first time through an investment dealer to the public. So for example, based on current interest rates, based on the current risk to be marketable, let's say we want to raise $1 million of capital, and we have to pay a coupon rate of 10% to make our bond attractive in the markets. So we will go to an investment dealer, and they will try to sell our bond to bondholders or investors in the market, and hopefully they are able to sell the $1 million in bonds to the public. So the coupon rate would be 10%, and let's say it's a 30-year bond, so it matures in 30 years' time, and the face value of that bond is $1 million. After the initial trading of that bond, we have a contract to pay the holder of that bond at the stipulated coupon rate over the next 30 years. However, investors might decide that once they've purchased the bond, that they want to sell the bond in the secondary markets. So investor A, he's bought, for simplicity, assume it's sold to $1 million is sold to one investor's initially at the coupon rate of 10%. And 5 or 10 years down the road, he decides he no longer wants to hold that bond and he wants to sell it to somebody else. So he goes to his stockbroker and offers for sale his $1 million bond that he is the owner of. However, let's say that interest rates in the market for other investors of similar risk and for similar maturities is actually now 15%. So who would buy a contract that pays 10% when interest rates actually are paying 15% on current investments? So the holder or the owner of the bond may have to reduce his price from the $1 million face value to something less than $1 million. For example, let's say it's $900,000 to make up for the difference in the between the coupon rate of 10% and the current market rates of 15%. So he may go to the market but not be able to sell his bond for $1 million, but only be able to sell it for $900,000, and so that $100,000 difference will compensate the new owner of the bond for the difference in interest rates between current market rates and the coupon rate. And conversely, if interest rates actually have fallen, the price of the bond that the initial investor gets might be higher than the $1 million maturity or par value of the bond, because it is now more attractive because other bonds for similar risk investments are have a lower coupon rate. So so once a bond is issued in the to investors. The investors can trade them on secondary markets, but the price of that bond will depend on the movement of interest rates in the market. There are many organizations out there, since Moody's and Standard and Poor, that will actually rate bonds, and that's a measure of the risk of the bond. So they will often rate the bonds from a rate of high, which is a AAA rating, which really means low risk bonds, and you would expect those to have a smaller coupon rate, to a lower rating such as BB or lower, which are junk bonds. And they have junk bonds are any bonds that have a higher probability of default. They're very speculative because there's a higher level of risk in that the issuer of the bond may not be able to pay either the principal or perhaps have missed some payments on the interest payments on those bonds. And in fact, the bonds might be already in default. Another very common form of long-term financing is a mortgage. And a mortgage really is just a credit facilities that is backed by real estate. So real estate would be land and buildings. And it calls for payment of a debt over, again, a longer period of time, often 20 or 25 years. So there's some key terms to be familiar with when talking about mortgages. First is the mortgage value, and that's the amount of money that a lender is willing to lend against the value of a property. Oftentimes that's for a business property might be 70% or 75% of the appraised value or the purchase price of a property. The amortization period refers to the length of time over which the mortgage will be paid off. And the interest rate term refers to the length of time that the interest rate will be applicable. So perhaps you or your parents have purchased a house. They will get a mortgage from a lender. So the lender takes the house as security for the loan. You will pay it over an amortization period of 30 years, but you will fix the interest rate for 5 years. So the interest rate is contractual for the next 5 years, and that's the interest rate term. At the end of the term, the mortgage either becomes due in full or is renegotiated at a different interest rate. And the interest rate really refers to the cost of borrowing for the term of the loan, not the specific amortization period. But the interest rate is only fixed for the term of the loan. So mortgages are very common forms of financing for businesses when purchasing real estate, property, plant, assets in your organization and paying them back over a long period of time. Long-term notes, again, are another form of long-term financing where companies will buy other assets besides real estate and make payments over a period of time. Typically, long-term notes might be notes that are paid over a shorter period of time than a mortgage. Often, many banks will lend long-term notes up to 10 years or perhaps even 15 years. And sometimes those are secured or unsecured, so they may have collateral. For instance, if you're looking at purchasing a truck or a piece of equipment, the bank might finance it over a 5 or maybe a 10-year period, and they will take collateral over the specific asset that you're purchasing as collateral, and in the event of non-payment of that debt, they would have the right to seize that and sell it to pay back the unpaid portion of the loan. There's a variety of repayment options. Some long-term debt has balloon payments or higher payments towards the end of the term. Some will have monthly regular payments over the length of time that you're paying back the promissory note. Some interest rates are either fixed interest rates for specific terms or variable, which means they float up and down and they're tied to the prime lending rate of the financial institution. And the prime lending rate is the base rate. So that's the minimum rate that the banks will lend money at to its best customers. And the prime lending rate is set by each financial institution periodically. And so it is a floating interest rate, and it goes up and down over the term of the loan, whereas fixed interest rates are fixed for terms of 1 year to up to 10 years. Leases are another form of long-term financing where assets are financed over a longer period of time with periodic payments, again, of principal and interest for the use of that property or equipment or whatever is being leased. Many leases include the opportunity to purchase the leased asset at the end of the lease. So a lease, typically, ownership passes at the end of the lease, as opposed to upfront when you are buying the asset outright. You are paying for a period of time and may have the opportunity to purchase the asset at the end of the lease. So typically leases or capital leases will be longer term, over 1 year in length. The lessor is the person that owns the land, equipment, or the property, and so that might be the leasing company. And the lessee is the person that rents the land, the equipment, or property from the lessor. So a lease is a common form of financing for many organizations for equipment financing, or even real estate where we may not be able to afford to buy the property up front or the land and building up front, so we may lease it from the owner over a period of time under contractual arrangements. So as a manager, we really have to consider the impact of the form and the type of financing or type of capital arrangements that are made in an organization. As a general rule, debt financing is cheaper to organizations because the interest cost is a tax-deductible expense, so it reduces the cost of financing compared to equity financing, for example. So typically debt is a cheaper form of financing. However, debt financing, because it has contractual repayment, whether it be a short-term loan or a long-term loan, has contractual payments and hence have an impact on the cash flows of our business, and hence can increase the risk to our business. And so whenever taking out debt, we have to ensure that that debt will improve the profitability in our company or increase revenues, for example, because it will increase the cost base in our organization. So we have to make sure that we are able to generate a return with the assets that are being financed with that debt. The third primary source of financing is, of course, equity financing. And when we're talking about equity financing, we're talking about selling ownership of the business. So we're not taking out a loan, which has to be paid back over a period of time. We're taking on new owners. And depending on whether we're a private corporation or a public corporation, we may have different levels of access to equity financing. If we're a private corporation, we might be able to raise some equity from private sources. So we're not selling our stock on one of the public exchanges, but we might be finding some friends or family who want to become owners in our business. Angel investors or private equity firms or venture capitalists are organizations that have money that look towards purchasing ownership interest in smaller businesses in the expectation of higher rates of return based on the profits generated from that organization. And when we talk about private equity, it can be either an investment of cash into our business, or sometimes it's the investment of equipment or other assets into the company. So keep in mind, soon as we look towards equity financing, we're really diluting our ownership interest in the business. So, for example, if a business has one shareholder, initially they have 100% control, and if the business, let's say it's a private company, and it looks towards getting another shareholder to inject money into the business, now we have two shareholders, and each one perhaps will have a 50% interest in the business. So we've diluted the equity, the interest of the investor in the business through the issuance of additional shares of stock. And stock is what represents the ownership interest to an investor in our business. And it represents a pro rata claim on the earnings of our business. Public equity is when we sell investors through one of the recognized exchanges. And something to keep in mind is that a company receives the proceeds from the sale of stock only at the time of the initial public offering. So we want to raise equity, we go to an investment broker and sell some additional shares of the stock to the public. That's the only time we receive cash in our business. After that, the shareholders might decide to trade shares amongst themselves in the secondary markets, as we mentioned before. That has no impact on the cash resources of the company. It does not provide additional capital to our business. If we do issue shares through initial public offering, keep in mind that this value, the existing prices of the shares, will often decline because now there's a larger number of shares outstanding. Concept of market capitalization value is the current market value of the organization, which is really calculated by taking the number of shares outstanding multiplied by the current value of the shares. So in your Mike Spikes project, you can take a look at the number of shares times the share price, and that determines your market capitalization value. In your Mike Spikes project, you might look at manipulating that by perhaps buying back some of the shares, which may increase your or decrease your market capitalization value, but might actually increase the price of the shares in Mike Spikes, because the profits are split amongst a smaller number of owners. Now, I've used that term prospectus a couple of times, and the prospectus really is the legal document that outlines all the terms and conditions of the share offering to potential investors, and it's filed with the Securities Exchange Commission. It's prepared by lawyers, and it provides a lot of information to investors so that they can properly assess the level of risk in the investment and whether it's something that they want to purchase or not. So again, managers really will have to look at the different sources of financing and determine what the optimum level of financing it is. So if looking at operations as a form of financing, through the retention of profits in the business, to making decisions to secure debt financing from creditors and what the implications might be on risk of the business through the increased leverage, as well as the cash flow impacts on the payments of interest and principal, as well as managers must look at equity financing and what that might do to the business, what the cost of equity financing might be. Typically, the cost of equity financing is a lot higher than that of debt financing. So it's a matter of finding the balance between internal operations, debt financing, and as well as equity financing in the business. So again, just a quick summary of the sources of funds. So funds from operations. Again, there's no external financing. There's no dilution of ownership. They don't have to be repaid back. No interest payments, so it's a fairly low form of financing as long as you're profitable. But you, on the other hand, we might not have enough internally generated funds to expand. We might need to expand now, so we might need to look at external sources of financing. And keep in mind that if we use the funds from operation to expand our business, that money can then not be paid to the owners in the form of dividends. The dividend, or the shareholders are going to have to wait for a cash return on their investment. Credit facilities or debt financing, again, the advantages are there is no dilution of ownership, and it can provide for large amounts of capital now with payments paid out over a long period of time. And so it allows us to buy that piece of equipment now and financing it from the profits generated from that asset over a longer period of time. And the interest expense is an operational expense, so it is tax deductible, and so it becomes a cheaper form of financing. However, some of the disadvantages and risks are that it has to be paid back, interest has to be paid, and so we, regardless of whether we've got the funds available, we're going to have to find ways to pay back both the principal and interest on the debt, or the creditor might be able to force us into bankruptcy or lay claim on certain assets and realize on certain assets if we've provided collateral for repayment of that debt. And the third is equity financing. Again, it's a little bit more costly form of financing, and it does dilute ownership. And however, the advantages of equity financing is that it doesn't increase debt, so it doesn't increase the level of risk in the organization. There's no obligation to repay, so there's no obligation to pay dividends to our shareholders, and it doesn't place pressure on the cash flow of our business to fund on our operations to fund the organization's ongoing needs. So again, you as financial manager need to find the right balance between funds internally generated and funds externally generated through credit and equity financing to best manage your business. Most of what we've talked about are sources of funds that are available to for-profit organizations, but not-for-profit organizations also have a requirement for capital. And the capital required, though, may be from different sources of financing. Typically, not-for-profit organizations don't generate revenue or generate a source of funds internally because they're not profit-oriented. So they rely more extensively on external sources of financing, such as the government or other organizations, through fundraising and appealing to other business ventures, concept of, or the attitude towards philanthropy and donations to the businesses. So fundraising efforts are big for not-for-profit organizations, such as the United Way, etc. Not-for-profit organizations typically have a more difficult time raising funds through debt because they don't have a profit motive, and profits are what pay back the debt, so sometimes have a harder time getting debt financing. And because not-for-profit organizations don't really have owners, they may have members and investors really don't consider them as a form of investment because they generally do not generate a return on that investment. So they're looking at fundraising and appealing to government and individuals to donate funds to the business so that they can continue with their strategic objectives. So most organizations will have a need for capital to expand, to replenish equipment, to improve equipment, to become more profitable. And so your job as financial manager is to find ways to acquire that capital, either internally or externally, and use it in the most effective way possible. So the trick is really to know which form of financing to use when during the life of the organization. So we really need to take a look at the cash cycle, both at the present as well as the future cash cycles and our future financial needs, and determining the optimum mix of debt and equity financing, as well as financing from internal sources. So that concludes the chapter on capital and the financial markets. A lot of material. Please read through the textbook and understand each of the forms of financing, each of the forms of business organization, and some of the strengths and weaknesses of either internal sources of funds or external sources of funds, such as debt equity.